Safety is something that we all seek in life. Aside from meeting the five basic needs of human survival, such as food, water, clothing, shelter, and sleep, safety is the next most important thing because we want our family to be safe. Now we install alarm systems and buy houses in safe neighborhoods. Our children's safety is always our concern, especially when they are teenagers and we are waiting for them to come home. In addition, we want our finances, savings, and investments to be safe as well. We have all heard stories of people losing their life savings and cannot imagine what it would be like if we were in their same shoes. There are a lot of fallacies out there concerning perceived safe and secure investments that are being peddled to the general population. Most people don't consider the downside risks associated with their savings and investments. To determine whether precious metals are truly more risky than more traditional ways of investing and saving money, we're going to highlight some of these risks in this video, so stay tuned. Money in the bank. Following the Great Recession, the Dodd-Frank Act of 2010 was passed. Although we won't get into all aspects of the bill, the overall goal was to protect the public and prevent future financial crises. Banks are now legally allowed to bail in when the next banking crisis hits, a provision in the bill that didn't make headlines at the time, but has since come to light. Following the 2008 and 2009 crisis, the government deemed some industries and banks as too big to fail and bailed them out with taxpayer money. That's right, your money, our money, and the American people's money. Under the Troubled Asset Relief Program, TARP, this was authorized. It is likely that many of the largest American banks would have collapsed if Congress had not passed this bill. It cost the government hundreds of billions of dollars to prop up these banks when they were essentially worthless on paper, especially if they had to mark mortgages to market. In marking to market, the value of loans is written down to reflect their value instead of using artificial inflated figures. Now, as we mentioned earlier, that the Dodd-Frank Act allows banks to bail in when the next financial crisis occurs by using their customers' deposits or saving account balances to stabilize the bank. In order to do so, they must convert your bank balance into stock. In my opinion, it would be much better for my money to be out of the bank rather than to be traded into some worthless bank stock. The idea isn't as far-fetched as it may seem. Bail-ins have been done in the past. Cyprus experienced a financial crisis in 2012. The Cyprus property market, which saw similar losses as the U.S. property market in 2008, was over-leveraged by Cyprus banks. As opposed to bailing out the banks, the government allowed a bail-in. While the first 100,000 in deposits was not affected, nearly 50% of deposits above this amount were confiscated. Does this mean that as long as you don't have more than 100,000 in your bank account, you're safe? No, not necessarily. The bank will likely leave small checking and deposit accounts alone, but will seize deposits in saving accounts and checking accounts that are over a certain amount. This information is not intended to stoke fear or panic, nor do we advocate a bank run. To share with our viewers the potential risk of keeping a significant amount of money in a bank, we simply just want to highlight it and make you aware. Federal Deposit Insurance Corporation, also known as FDIC. FDIC insured is a term that we've all have heard, but do we really understand what it means and how it works? Now, following the Great Depression, the Federal Deposit Insurance Corporation was established in 1933. The bank's clients' funds were not insured until the Great Depression. So the bank failed, the clients' funds went with it. Now, during the Great Recession, the Emergency Economic Stabilization Act, EESA temporarily increased insured funds from 100,000 to 250,000, which then became permanent. Up to this limit, the public was assured that their money in the bank was safe. So far, none of the major banks have failed, so the limits of this program have been yet to be tested. Now, approximately 18 trillion in deposits are held by FDIC insured banks at the time of this video, but a significant portion of those deposits are above 250,000. So the total estimated insured deposits are roughly 10 trillion at this time of the video. In the event of a banking system collapse, you would expect the FDIC to have assets close to their exposure. Well, if you take a look at FDIC's assets, show that it is woefully underfunded. As of March of 2023, it had only 124 billion in assets. As a result, FDIC insurance only covers 0.0124 cents of every dollar eligible for coverage. A collapse of any of the four largest banks, namely, say, Bank of America, Wells Fargo, Citigroup, and JP Morgan, would bankrupt the FDIC, even though the agency is supposed to have sufficient assets to cover failures of smaller financial institutions. In case you're concerned that the FDIC lackluster's limits will only pay you pennies on the dollar, you should be. If you are concerned about your banking risk, you may want to really revalue it. Check out credit unions or community banks that have stricter underwriting criteria and may be less susceptible to shocks to the financial system. Or, if we're being completely honest with each other, it now seems that money under the mattress is safer than keeping it in a bank. 401ks. A defined contribution plan such as a 401k is partially or entirely funded by employees. Companies usually match employees' contributions up to a certain percentage, but they're not required to do so. The ICI estimates that 6.3 trillion was invested in 401k plans as of September 2022, which accounts for approximately 1/5 of the estimated 32 trillion. A cash-strapped government could generate substantial revenue from this amount of money. In the past, Congress has proposed replacing 401k funds with guaranteed government bonds, The concept is similar to a universal basic income. In this scenario, the government would step in and make decisions for Americans rather than letting them decide for themselves. Don't be surprised if this topic arises after the next financial crisis following a sharp sell-off in the stock market. What do you think about this scenario? In the same way that the bail-in in Cyprus had presented that this type of proposal might be implemented. Performance of 401ks. While confiscation of 401k plans may seem unlikely to most of our viewers, they're still far from risk-free. All of us have sat through presentations from our company's 401k provider and read the fancy, glossy marketing materials full of charts and graphs. By the time we're 65, we'll be millionaires by simply investing an X amount per paycheck beginning at the age of, say, 25. Most people in the industry failed to bring up one of the most important issues with 401k plans, that hardly anyone earns the reported compounded returns in the company's fact sheets. Despite the fact that the stock market on average returns 8 to 10% a year, this is an average and does not reflect investor performance. It appears that the average investor earns closer to 3% a year according to reports we've seen and read in the past. This is due in part to investors panicking during crashes, causing them to sell low and at the worst possible time. Conversely, when the market is highly valued, they tend to add to their stock holdings after a big run-up in the market known as a bull market. A highly valued market almost guarantees underperformance. In addition, average returns aren't the same as compounded returns. In 2022, the S&P 500 returned a negative 20%. It would seem that you would break even after a 20% increase in the following year, but that's not the case. In order to simplify things, let's say that the S&P 500 is at 4,000. Now a 20% loss this year will leave the index at 3,200, while a 20% gain the following year would only make it 3,840. That would be a 160-point drop from where it was previously. For the stock market index to rise 4,000, a gain of 25% is needed. Although a 5% difference may not seem significant, it certainly adds up over the course of time. A 401k's plan's diversification options can be challenging. To reduce volatility and potential losses, most wealth managers recommend a 60-40 stock-bond split. In 2022, how did that turn out? Well, the S&P 500 lost 20% and the aggregate bond market lost 13%. The 13% loss on the bond was actually a good return compared to some notes and bonds, which lost upwards of 40%. With a 60-40 split, your combined return would have been minus 17. Not exactly spectacular.